Good afternoon. This is Coach Mike from WinningStockCoach.com. Going to go over our weekly market overview video, as is custom for us. A couple things. We're going to start on the weekly chart for the SPX, which is your S&P 500. Last week was kind of a brutal week, many would say, with the markets, but if you watched last week's market overview, then this past week was not a brutal week for you at all, because you were prepared and you were ready to act upon the decisions you had already planned for. An interesting thing to show here is that on our weekly chart, we had marked a channel right here, this pink dashed channel, that indicated the price channel the S&P 500 had traded in since the induction and the increase in QE3 stimulus. As the Fed has tapered from quantitative easing, we have talked about the expectation that once QE3 was dissolved or at least lessened enough, that we would see the markets fall out of this trend line in this channel that had began back in November 2012. But it wasn't until this past week, the week ending on April 11th, 2014, that we finally closed below the channel line. Now, we've talked for months now about our Fibonacci time series and the projection it gave us for the week of March 3rd to give us the market high close. And as you can see, that close from that week is still serving as our highest weekly close on the S&P 500. But it is also important to note that there have been high prices made since then. They were just unable to sustain. With this drop here, and I have Friday's close marked with this horizontal line just so you can see it clearly on this mountain chart. And we have a couple things we need to look at with this. First of all, as we fell outside the channel, that's clearly indicating to us that there is a difference in trend being shown. Does that mean you can't get any more up moves? Absolutely not. In fact, we could get up moves and maybe even still make higher highs, but the indication here is that the trend will change. And we've seen that on a few charts over the past few months, is even though they started making higher highs, they weren't trading within their regular trends. The abrupt ascending channels that had been created were starting to shift more towards the flattened side, even though they may still be pointing somewhat upwards. And we are starting to see that and confirm that now, and we've really been waiting for the S&P 500 to give us that indication. In last week's market overview video, we discussed the interim support level at 1855.42 that, should the markets remain in their consolidation pattern that we had seen really since early March, that we would expect that that still could be a bounce point. Early in the week, we failed that point and did not stay above it very long at all. And we said that if that point failed, we would then expect, if the markets were to remain bullish and maybe at least trade similarly to how they traded in January's decline and February and March's incline, that we may see 1784.36 as a potential bounce target. Now, in looking at this chart, I don't think it's hard to believe now that the 1784.36 is at least obtainable. In fact, with the upcoming week being a holiday week and a shorter trading week than normal, one of two things would be my projection. The first could be a low volume flat week. Typically we see those on holiday weeks, lower volume, not much movement at all. I wouldn't be surprised to see it. The second would be what we see a lot of times on holiday weeks as well, a low volume decline in price. And I'm not going to be one that sits and tells you we will get one or the other. I'm sitting and telling you that This week probably won't be a heavy trading week. That'll probably be indicated by the volume on mini charts. And I'm simply going to let the markets make their move to indicate to me when proper opportunities will be there. And I don't think the proper opportunities will be there this week. On the DJI, the Dow Jones Industrial Average, we spoke last week about the necessity of holding around that 16,171.44 value, and Thursday's close kind of left us right at there, not knowing if Friday would be a breakdown or a breakup from that point. And Friday gave us that clear indication. It opened right there in line with it and fell. We had also marked these horizontal lines from our weekly chart that indicated a consolidation series that we had done the majority of the trading within, and we've now broken down from that and created a lower low. If I was going to look for an expected bounce point on the Dow Jones Industrial, it would probably be around 15,382.17. There's a lot of things going into that projection, and does that mean it'll fall straight there without a single green candle? Absolutely not. I mean, we see as it fell here, it actually hit my bounce target, bounced off of it, but didn't like the bounce point and then crashed through it. So I think that we could get a series of ups and downs through the process. And if I use the same tool to indicate one of those bounce points, we could actually see that come this week with a shorter bounce that I believe would again give us a lower high, but could indeed still give us a bounce off of there. The one that gives me the most concern is our small cap index, the Russell 2000. I had placed a bounce target, or at least a support target, at 1113.50. Now, we didn't close much below there, hitting the 1,111.44 with Friday's close. So it is fairly close there. And what I want to focus on with that is it's so close to that point that, again, I would not be surprised at all to see a bounce coming off of this point. But the fact that it did fail my support target also would have me not surprised if it were to break down further. It's been a long time in the making, but as we can see on the Russell 2000, that we don't see yet necessarily on the S&P 500 or the Dow Jones Industrial, is the occurrence now of lower lows and lower highs being created. And we haven't seen that for going on about 18 months. So to see it now, plain as day, it's not a debatable fact looking here at our indices that the trading patterns are beginning to change. That shouldn't be something that scares you out of the market. That shouldn't be something that scares you from a position. But it should be something that has you identifying the change now, because as I pointed out when we talked about the S&P 500 chart, many charts were starting to change their trend from the very abruptly inclining ascending channels they had been in for quite some time to a more flattened channel, but it was still a more flattened yet upward trading channel. And we're still seeing that a lot here. But it is something you need to identify when defining the trends on the charts that you're following, so that you can also identify when those trends move from any upwards move to a flattened trend or even a downward trend, based on whether or not they're consistent with higher highs or lower highs, higher lows or lower lows. And the Russell 2000 being really a leading indicator in the indices over the past couple years, we found that within a few weeks, the Dow Jones and the S&P 500 begin to mimic the moves seen on the Russell 2000. So, as we've been covering the indices in our market overview videos over the past few weeks, or actually past 3 to 4 months, since we've been putting them out to people other than members of the coaches roster, we've started to find a lot of the stuff we've talked about during that time has begun to come true with the shifting of trends, with the breaking down and creating lower lows or lower highs, and the volume differences seen in their tradable ETFs. And what volume differences might you be talking about? Well, we're going to look here at the SPY, which is the S&P 500 ETF. And you're going to see that the pattern of volume bars here. And this is what I'm really looking at. Where your green bars are fairly consistent in size, and the red bars, which are indicating a red day, a down day, are in many cases at least 50% higher. This is something we've been tracking for some time, because as the market tried to squeeze out a little higher and a little higher, we started moving up at a much slower pace. But at any time the market looked to be pulling back, the volume increased, because, I mean, it's a clear indicator that others were scared that that time the market had topped out. No, it inches out another target, but as it comes down, people think the market's topped out. And again, as it pops out, they slam it down because they believe the market's topped out. I would believe personally that if we were to see any type of bounce in the S&P 500 over the next 1 to 2 weeks, it's going to be in the area for the SPY between 179 and 180. That being said, because of the 3 already bounce points from that area in the past, and that would be an area that I'm watching. So knowing that this week ahead of us is typically a slower week because it's a shortened week due to holidays, my anticipation is that patience will be key, and that you need to wait and let a bounce happen before you convince yourself that something's worth entering. By doing that, you will be able to enter stocks closer to the support levels, minimizing your risk in conjunction with your trade plan and your stop out points. This is Coach Mike from winningstockcoach.com, wishing you the best of luck in this upcoming week, and a happy Easter this upcoming weekend.